Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and also one of the founding partners of the Dividend King Seeking Alpha marketplace service. And the video I'm going to do today has a lot of controversy attached to it, something I've struggled with and argued with people about probably over most of my career, and it really has to do with, the safety of bonds versus stocks. And, bonds are always considered very safe in academic, circles. You're always supposed to have a balanced account. Most people would argue the 60% in stocks, 40% in bonds, or vice versa. And they create all these artificial constructs. But there's this general notion that bonds are innately safer than stocks. Well, very early in my career, I had the good fortune to watch a presentation by a mutual fund manager, an equity manager, who favored equities over bonds. And he did a presentation that really struck me and struck a chord, but it also stayed with me over my first career. The first thing is he addressed this equities versus fixed income concept as ownership versus loanership. And he said, owners always win. You always want to position yourself, in his opinion, to be an owner, where you want to participate fully in the growth of the business that you were investing in, because that's where all the opportunity was and that's where all the profit was. And then he said, in loanership, you're loaning your money at fixed interest. But he said what that ultimately would do was lead to what he called guaranteed failure. And I'll explain what that means here in a few moments. But the point is, there is this notion that, Wall Street has and academics have, that bonds are innately safer than stocks. Well, I don't think that's necessarily true. First of all, I don't like overgeneralizations. I don't talk about all stocks or all bonds and paint everything with the same broad brush. As I often say, it's a market of stocks, and there's a lot of different kinds of stocks, and you can rate stocks by their quality and their safety, and then there's also lots of different kinds of bonds. But also, I think it's important to recognize with fixed income that fixed income is also subject, from a standpoint of price volatility, to changes in interest rates. If you buy bonds in today's low interest rate environment, interest rates rise dramatically. As a rule of thumb, and it's a very loose rule of thumb, for every 1% rise in interest rates, you could see a 10% deflation or devaluation of your bond portfolio. Bonds do fluctuate just like stocks, and bonds technically, theoretically at least, could fall in value significantly further than stocks did, even during the Great Recession. That's a thing that most people, feel is not necessarily a possibility, but I'm here to tell you that it's a real possibility. So, the idea that bonds hold their value, bonds fluctuate. Anyone that owns a bond portfolio of individual bonds sees that their bonds change. Now, in the last couple of decades, bonds have actually been a great investment if you bought them 10, 15, or 20 years ago, when interest rates were significantly higher than they are today. For example, 10 years ago, a 10-year Treasury bond, offered about a 3.29% yield. It's around 1-something% today. I'd have to look it up. I don't know the exact number. But the point is, interest rates have fallen dramatically. Even earlier than that, you could get 5 and 6 and 7% on even a 10-year Treasury bond. So, the point is, whether bonds are better investments than stocks, or whether, bonds are safer investment than stocks, is always relative to the scenario and the situation you're in my opinion. So what I'm going to do here, I'm going to go through a presentation with you and kind of, build on this concept that because of inflation, bonds actually would generate what this gentleman that taught me this he called it guaranteed failure. Yes, they were guaranteed to get your money back, but you're also guaranteed to lose money. So let me explain. If you invested $1,000 in a 10-year Treasury bond, and I'm going to go back 10 years here for the sake of this presentation I'm doing, this video I'm doing, you could have got 3.29% on a 10-year Treasury. If you invested $1,000 in that, we've had inflation running approximately 2%. So I'm just using this as, approximate numbers here. I'm not trying to be overly precise with this. I want to be more conceptual than price. But if you invested $1,000 in a 10-year Treasury bond at 2% inflation, 10 years later, that $1,000 had purchasing power of $817. In other words, you would have lost 18.3% loss of purchasing power in a decade. That's at 2% inflation. So you did get a check that had $1,000 written across it when your bond matured, if you will. But that $1,000 in today's dollars only bought $817 worth of goods and services. Now, at 3% inflation, just to keep this perspective of guaranteed failure, alive, at 3% inflation, you would lose 26.3% of your purchasing power. a $1,000 bond would only be worth $737 in real purchasing power dollars 10 years later if you'd have gone back 10 years ago and bought a $1,000 bond and we had 3% inflation. If inflation would have been 4%, you would have lost 33.5%. And if at 5%, you'd have lost 40%. A $1,000 bond would only be worth $599 in terms of purchasing power. Now, the truth is we had about 2% inflation. So this is the number that you would have experienced in the last decade. So let's compare that. Let's look at that in contrast to what you could have done with equities like utility stocks, because one of the other controversial parts of this subject is whether or not you can use dividend growth stocks as a bond substitute. That's another very controversial issue. Some people say you can't because bonds are always going to be safer than stocks. And my argument is that they're not, unless everything is right, unless the interest rate's high enough so that you're not going to get, killed in terms of income. But the other side is, all investments need to be made when they make economic sense. And my argument is, in the 50 years I've done this, I've always used a balanced portfolio. I had stocks and bonds in many, many portfolios. But the reason was I could invest in bonds because I could get a much higher yield on a bond than I could stocks. Number one. Number two is, I did have that safety factor that I could get a return of all my principal regardless, of inflation. In other words, if I invested $1,000, I'd get $1,000 back. Might not buy as much as it, did 10 years later, but I would still get my $1,000. So there was that, that quote unquote guarantee of safety, if you will. But what I really needed, if I was going to do that, what I really needed was I needed to be able to invest in something that would give me a chance to do better than inflation. So for sake of this video, I'm going to use select utility stocks. I'm going to start out, first of all, with UGI Corporation as a gas utility. I want to make some points here. All right, number one is that, there is no guarantee with stocks, that's true, and stocks can be volatile. But as I've argued many times before, as Mr. Valuation, if you invest in a quality dividend growth stock, even a utility stock, such as UGI Corporation, which is a gas utility, and buy it when the valuation makes a great deal of sense, you really de-risk your portfolio, your equity portfolio a lot. Equities are much more risky when they're overvalued than they are when they're undervalued. Okay, number one. In the case of UGI here, the gas utility, first of all, it had a growth rate of 6.23% over the last decade. Now, that's a very high growth rate relative to most utility stocks. That's why I'm starting out showing it as my first example. There is price volatility, but that volatility only matters if you intend to sell. If you buy the stock to own it, then the volatility shouldn't bother you too much, especially if you bought it to get the dividend income. Now, looking at that back when I would have, looking at this time frame back here, I'd have been looking at a dividend yield on UGI that was, very high, well over 3%, as you can see here by, just looking out at the interest rates here on the right. So the point is, I'd have started out with a nice interest rate. The 10-year Treasury was yielding about 3% at the time. But after 1 year's time, if I invested in UGI, my yield would have been 3.6, which was, comparable to the Treasury. But then I got the growth yield. Every year my income would actually increase, where in the fixed income, the Treasury bond, my interest stayed at 3.9%, 3.9%, 3.9% the whole time. Now, my dividend growth in UGI was about 8% a year over the last decade, and I would have turned $10,000 into $27,155. Now, let's put it at the same level as we did the bond. If I took 20% at 2% inflation, if I deducted 20% of the value of that as, purchasing power loss, that $27,000 would still equal $21,700, or I would have more than doubled my money. Now, I'm not reinvesting dividends here. I'm spending the dividends. The point is my principal would have grown, would have actually doubled in value, and that would have certainly compensated me for inflation running at about 2.1, 2.2% over that time frame. Now, if I go to a more traditional utility like Southern Company, for example, if I look at Southern Company, the long-term 10-year growth rate of Southern Company would have turned $10,000 into $16,000, $22,000 counting the dividend income. That would have given me about $17,000 in nominal purchasing power, which is obviously better than I'd have got from, owning the 10-year Treasury bill, where I would have lost almost, 18% of my principal. And again, I had reasonably attractive value on Southern Company at the time. I did have volatility along the way. The stock is a bit overvalued right now, but even if I measured this investment to what I would call fair value, which I'll go out just to next year, I'd still make over 6% a year, which was double, total annualized rate of return, which is double what I'd have received from the Treasury bonds. The next stock I want to look at is Pinnacle West. Now here I've got an A- rated utility stock, average growth about 4.48%. I could have bought it at an attractive valuation back in 2010. I want to make that point real clear. If I look at it from a standpoint of its historical performance, my dividend yield the first year would have been 5% versus the 3.9 I was getting in the Treasury bond, but it grew to over 7.7% through growth yield or yield on cost, averaging only about 4% growth, but even that beat inflation. But once again, I would have had a total return of more than 2.5 times my original investment, where I'd have only got the $1,000 back with the dividend, notwithstanding the fact that $25,000, in Pinnacle West would only be worth $20,677 in purchasing power. It was still more than twice what I originally invested, and that's the point I want to continue to drive home here. If I go to my next example here, OGE Energy, I do want you to notice if I look at it from a historical point of view, I got about 2.96%, or we'll call it 3% growth. Once again, it was attractively valued at the time. So if I go and look at the performance over that time frame, I have 10,000 growing to 19,000. Again, that still beats what I would have done in the Treasury bond. My yield would have been about equal starting out, but I would have every year I'd have increased it. And the key I want to make here, a key point I want to make here is that, we're talking about safety from the factor of predictability. I could predictably get $1,000 back on the Treasury bond, but when I look at the practical, look at dividend-paying growth stocks that have long histories of increasing their dividend, I have, the most predictable thing about investing in stocks is the income. So if you're focused on that, the dividend income can, really make is a game changer as far as the investment. Are stocks riskier than bonds? Yeah, probably if you're just focused on liquidity. But from a standpoint of income generation, I'm going to argue that, stocks are probably as safe as bonds, at least from my perspective, especially if you're investing in, dividend aristocrats, or even when you look at utility stocks. Keep in mind, these are regulated businesses, so they do get some, have some controls just like you would if you're looking at a bond. And then the next one I want to go to is Edison International. Once again, I see a utility stock that's tremendously undervalued. I only have 2.58% growth over this period of time, which isn't necessarily great. But if I look at it from a performance point of view, $10,000 invested 10 years ago would have grown to $20,519, $15,000 on capital appreciation. So my original $10,000 investment actually increased to $15,600 plus dollars. I did receive 4.89% on dividends. My dividends grew at twice the, almost 3 times the inflation rate. And the point is advantage equities. They don't give you any real guarantee, but they do give you the chance to participate in the growth of the business. And then if you simply make sure that you buy the stock, invest in the company when there is a margin of safety like you could have back then, you really reduce the risk of the equity a great deal by doing that, in my opinion. And then I'll close this out by saying, you can also look at things like Johnson & Johnson, which is a AAA rated, supreme quality dividend growth stock with a long history of raising its dividend every year. And it's been very predictable and very, constant, if you will. You could have bought it 10 years ago at a discount to its intrinsic value. And that's a very important part of this theme. I'm not just saying buy equities at any price, just like I'm not saying buy bonds at any yield or any price. Investments have to make sense at the time that you're investing in them. Johnson & Johnson made a great deal of sense at the beginning of 2010. You could buy it at 13 times earnings. If I look at it from the standpoint of performance over that time frame, the dividend grew by 6.6% on average and compound average. 10,000 would have grown to 31,000 including dividends, but my principal would have gone from 10,000 to 26,000, or 2.6 times my investment. Now, if I mitigate that, my total 31,000 would only be worth 25,000 in purchasing power, but that's worth significantly more than the 10,000 in the bonds that would have depreciated by 18%. So, this idea of just carrying these artificial constructs and notions in your head never really made much sense to me. I believe you should always be using your intellect when you're making investments. There was a time, by the way, and I think it's important to point this out as I close this video, I was able to get double-digit yields on treasury bonds, many, many years ago. At that point, it didn't make any sense at all for me to invest in stocks if I could get 14%, for example, even as high as 16%, I believe, at one time, buying a guaranteed bond. I mean, it was crazy. I was getting, I had it locked up. Why would I even want to take a chance on owning an equity there? But at today's interest rate levels, with rates, on the 10-year treasury bond, being as low as they are, I think currently at about 1.6% as of March 31st, it doesn't make a lot of sense. It wasn't too long ago we were getting negative yields and even a 0.5% on treasury bonds. This idea that interest rates have gotten so low really turns out to be advantage equities, in my opinion. So I actually believe when you consider things like inflation and quality and valuation, stocks can be a lot cheaper. Now, I don't think Johnson & Johnson is necessarily better than a bond today because of its high valuation. But if I was investing in maybe not a AAA rated, but if I wanted to look for an A-rated company, something like Prudential Financial, for example, might be a good idea, where I could invest in it today with almost a 5% dividend yield, earnings yield of 11%. And, the reality of it is I'm buying it at a very, very low valuation. So this is something, and it's A-rated with only 20% debt, I could choose in lieu of buying a bond that's not paying me really anything. So, are stocks safer than bonds? Are bonds safer than stocks? My answer is it depends. Sometimes one is, has advantage over the others, and other times the other has the advantage over the other. You really have to use your judgment and your common sense and be realistic when you're making investments, and don't get caught up carrying these artificial constructs around in your head. You don't want to use bonds if they don't make any sense and if you stand a chance to lose money by owning them. On the other hand, if you can get a lot of yield from them and a lot of safety, bonds could make sense. This has been Chuck Carnville saying thanks for watching. If you enjoyed the video, ring the bell, give me a thumbs up and a like, and if you haven't subscribed to my channel, please do. I appreciate y'all. Look forward to talking to you again real soon. Thanks for watching.